Power Producers Shop Talk, where we are refining and redefining the sales game by equipping you with the tools you need to differentiate yourself in the marketplace.
Listening to the podcast is only going to get you so far. Why not take your game to the next level? Check out Power Producer Basecamp on killingcommercial.com today.
Tactical skills that'll help you provide deliverable value to your clients and prospects.
Want to have the sweet swag that we send out from the Power Producers podcast for your clients and employees? Check out policyt.com today.
And action items that you can provide to take your prospects and clients to the next level.
Want to create an online presence but don't know how to start? Check out crushingcontent.com. It's done for you, so all you have to do is show up.
This is Power Producers Shop Talk, production redefined. Are you ready to feel the power?
What's up, everybody? Welcome to Power Producers Shop Talk. We're here with Warren Cleveland from Captive Coalition for the third part in our four-part series. And in this episode, we're going to talk about captive insurance fundamentals, what agents really need to know. And listen, by fundamentals, we're not going to give you a freaking doctorate degree. These are the things you absolutely have to know. If you want to know more, if you want to get deep, Warren's going to give you an avenue to do that and show you how you can do that. But you're not going to get it on a podcast where we try and explain it to you over audio only. So we're going to give you some fundamentals, some big building blocks to build the foundation on. But if you want more, you can go to Captive Coalition and he's going to show you how you can do that.
Yeah, thanks, Dave. So, in going to this place about what the fundamentals are, I want to bring everybody back, right? When I was losing that $300,000 client, I looked around and there's none of this. You can't find it. Like, the education is so hard to come by, and agents are just getting absolutely kicked in the teeth with these big accounts because they don't know where to go, right? That's the whole reason we created this platform. And I appreciate you having us on. So, what are captives? What are they really, right? You're just creating an insurance company that shares risk amongst its members for the group, right? You have a group captive. They share risk amongst each other the same way the traditional insurance company works, except now the owners of that company keep the underwriting profit, not the carrier. So that's the big distinction, right? So you give a business owner the ability to share some of their risk, take on a little more risk, but now keep the benefit of that. That's really what a captive insurance company does, okay? And we talked about in our last episode, the 65-35 split, right? That's most insurance companies operate that way. 65 cents is loss funds or underwriting profit. You can call it either way, depending on what, glass half full, glass empty. And 35 cents runs the business. Captives run exactly the same way, right? Of that 35 cents, you're buying reinsurance, you're buying, from a fronting carrier, so everything looks the same on the outside to the outside world for contracts, et cetera. But the captive runs on that same premise. How do we get that 65 cents back into the business owner's pocket when they have a great year? Okay. Now, different captive models. So if you've been in the insurance industry, you've heard group captives probably. You've heard what's called a single parent. You've heard segregated cell captives. Group medical benefits captives, rent a captive. There's all kinds of different jargon. And I swear the industry does this on purpose to confuse agents and surely insureds on what the hell we're talking about, right? The more complicated we can make it seem, the more difficult it is for them to understand and say, okay, I don't want to learn this. I don't know, Dave, you back me up on that. Don't you think the true greatness of an agent is the ability to take that mess that we create in the insurance industry and just make it very simple, no jargon. Would you agree with that?
Mm-hmm.
Yeah. So the different captive models. So a group captive, you take a bunch of businesses, you put them together, and you'll either have the same kind of business, that's a homogeneous captive, or different kinds of businesses, that's a heterogeneous captive, right? We launched heterogeneous captives because I don't want one systemic thing causing a problem and then blowing the whole thing up. Think of, Chinese drywall, right? And if you had a bunch of drywall contractors in one captive and Chinese drywall showed up in Florida And boy, that was a mess, right? Remember that, Dave? That
Oh
was
yeah.
a disaster.
We're still
And
paying
so,
for it.
yeah, yeah. Um,
Chinese
so
drywall, honestly, is what really made, in my opinion, and I've only been in the industry, for 20 years, but I feel like this happened relatively early on in that 20-year tenure. But
yeah,
I mean, that's what really made underwriters start paying attention to chain of custody and where things are manufactured and all of that, because
yeah,
prior to Chinese drywall, it became it was kind of the Wild West. They were writing products exposure on literally anything and everything. And then that one came back to bite them. And I mean, I can remember very specifically having a large supply house, a distributorship as a prospect, and they were getting like plumbing fittings and things like that from China. And it was getting shot down everywhere because of completely unreal. They didn't even sell drywall, but because of what that
yep,
did, it made it
yep,
nearly uninsurable.
yep. Agreed, agreed. So anyway, go back to the different kinds of captives. We talk about the group, heterogeneous versus homogeneous, the single parent, right? Single parent cell means you're big enough to have your own captive. You don't need to share risk with other members, right? So the typical member in the group is anywhere from say 250 to 1.5 million in premium. Um, Different reasons for what that and how each one's structured. The single parent would be north of that, right? So our chief underwriting officer would probably tell you it's even higher. It's probably closer to 2 million, because between what it costs to have a fronting carrier to do all these other things, you still have to operate under that 65-35 split, right? So for every dollar in premium, 65 cents of that is loss funds. Well, you start whittling away at that with fees and what it is to buy reinsurance and have actuaries and set the whole thing up yourself and the collateral and all that. You got to have a really big number before that actually starts to make sense. And then you've got cell captives. So this is the old rent a captive, what people would have known as rent a captive or segregated cells. And these are where this is actually makes joining a captive or setting one up fairly much more efficient than the other single parent, is because you already have somebody who's got a core established and they're renting you a cell. So you're creating an insurance company of an insurance company, and the cells don't share risk amongst each other, and they're separated via liability. So you have the ability to have a cell that stands on its own. Now, look, without getting into the whole IRS and what's insurance and what isn't, there's some nuance there that's super, super important. So, one thing to mention, 831B, please, for the love of God, don't mess with that. All your members, please, please, please don't do that. The IRS is coming down on these things. We don't do them. 831B is not a captive. It is a tax election. It's irrevocable. And the minute your insured gets a captive promoter calling them and says, hey, we're going to set up an 831B, advise them. I've got a ton of stuff on my website. You can go and research it yourself. It's free. Go learn what that is. But the minute you check that box and your captive is now an 831B election, how it has that, it takes that 831B election, you are a spotlight for the IRS. They're going to audit you. There's 1,900 tax court cases right now still. And by the way, the IRS has not lost one, right? They've not lost one, and there are 1,900 pending to still come through. This is the absolute quick way to get yourself in a whole lot of aggravation and trouble. So
why are people doing it? I mean, what's the plus side? I'm not familiar. I'm not going to
Well,
sit
this
here.
is what
I'm
I'm
not
if
going to
this
sit
is
here and
what I'm
pretend like I
thinking.
know what the hell you're talking about.
Yeah,
yeah,
no,
no,
if this is what I'm thinking of, like I actually not currently, but probably 4 or 5 years ago, both of these companies ended up getting acquired, but they had essentially a captive set up that they were dumping a bunch of money into to avoid
see,
having to pay taxes on it.
taxes.
But they
Mm-hmm.
were fully insured with us. Like that was the whole
Well,
thing. They bought a
yeah,
guaranteed cost program for
yep,
all of their insurance. And I mean, I looked at this and I'm like, hold on a second. You're telling me that you have this captive that essentially on paper says you're putting money in to cover all of these risks at this retention level and all of this stuff, but you still want to buy insurance over here too. Something doesn't smell right.
yeah. So let's go back. The foundation of an 831B election came out of the liability crisis that we experienced in our country. And so these small mutual insurance companies in the Midwest were like insuring a lot of farms and whatnot. And so Congress passed a law that said, hey, and it's indexed every year for an increase, based on whatever CPI or something. And it says right now it's like 2.5 million, I think. If you're an insurance company and you make less than 2.5 million in premium and you take this tax election, you don't pay tax on underwriting profit, only on investment income. Right? So think about that. You don't pay tax on underwriting profit, only on investment income. Well, an insurance company, there's two ways you make money: investment income and underwriting profit. So investment income it can be sizable, but it's a smaller portion of than underwriting profit.
Well, if you got a captive and people are paying, you are paying premium into your own captive and making no claims against it. I mean, you're getting tax-free money, which is almost 100% profit.
That's right. And while there are plenty of 831, there are plenty of captives that were created to solve a problem, meaning I can't get insurance for this particular segment of my business, and I need I want to put it in a captive. I'll fund it myself. We'll create it. We'll use actuarial science to determine what our loss pick is, meaning what is our estimated loss cost for the next 12 months? Like how much or potential loss are we looking at? And then add expenses to it. And that's how we come up with premium. We're going to have a real transfer of risk, right? With an insurance contract we're going to have. We're not going to backstop the captive by supplementing it with the money from our business. There's a bunch of things that the IRS looks for, right? But what happened is that, of course, you take a good idea and some idiot says, oh, well, we can make money doing this, right? So you got a captive promoter, which, by the way, you don't need to have an insurance license to be a captive promoter. That should be the first telltale sign. If you don't have to have a license, there's no culpability. Nobody can come after you, and those guys just disappear into the woodwork. So what happened now is that you had businesses being pitched this idea they could have insurance and a captive and hide a bunch of money, right? So the minute you say that, the IRS says, okay, that's a problem, right? So when you come to us, your captive has to be about insurance. First, second, third, 100th is all about insurance, 100%, right? It's not a tax play at all. The 831B is pushed as a tax play. You can have a hurricane insurance on your $10 million building in Montana, which has no chance of getting hit by a hurricane, and we're gonna charge $1 million in premium for that, and we're gonna put it in your captive insurance company. So you could go buy that tomorrow in the commercial market for $10, but we're going to charge $1 million and we're going to stick it in that bucket. Well, the IRS comes along and says, how'd you come up with that premium? We made it up. Well, okay, where's your risk transfer? Well, we have this piece of paper. Well, have you ever filed a claim? No. 10 years, you've never had a claim. Now, this is where the industry and the IRS have kind of going back and forth, because there are people who have actually created these that they've had losses or haven't had a loss, but properties is somewhat different. But you inherently know what I'm talking about. You can't go do this or earthquake insurance in South Florida, right? There's no chance of that happening, or there is. You could buy the coverage for pennies, but I'm gonna put $1 million policy on my building, or you pick a coverage. It doesn't really matter. They all did this kind of same thing, and so the IRS, of course, got wind of it and said, this is not backed by actuarial science. There's nothing real here. This is not insurance. Not only are we going to hit you for fines and penalties, your insurance company is disavowed, so to speak. It's not a thing. And so therein lies the problem with 831B. So the IRS goes off the deep end in prosecuting these and searching them out, and has come up with rules that say if you have a loss ratio of X, you're a listed transaction, which means you're essentially like a focus for audit, period. Does that explain that, Kyle?
Yep.
Like, it's so dangerous. A lot of CPAs won't do the books on them because they don't want to have to sign off on them.
Yeah.
What have we missed, man? Anything? I know, like in bullet points.
Misconceptions. Let's talk about that. Let's talk about misconceptions. A friend of mine is the chairman of the board of a publicly traded company. And when I was a retail agent, I started talking about captives, and he's like, our agent said we weren't big enough. And I asked him, I'm like, how much premium are you paying? That's a guy, I knew him somewhat. And he says, oh, $1.5 million. Manufacturing. I'm gonna let that one sink in to everybody listening. $1.5 million, and his agent said he wasn't big enough. Now, this guy trusted his agent. Now, I mean, that was the knee-jerk reaction from the agent who didn't understand what he was talking about, you know? And so what happened is that they eventually went to a captive, right? And this is, you know, I knew him, but not well enough, but eventually they went to a captive without that guy. So I think that's important, is that don't play that game of I don't know and say something you're going to regret. But the common misconception is you're not big enough. And look, if you're spending 250 grand CompTIA auto or $1.5 million, 2 million, and you're on your own, like that account you were talking to me about, Dave, about the $2 million, you know, potentially they could be on their own, just depends on risk distribution, or it's too risky, or agents get cut out. While that can be true in other forms, you know, captive coalition, we don't do that. You know, the too risky piece is, I don't think anything's too risky if you understand the risk, right? As long as a business owner understands the risk and you're the agent helping them and you can explain it, and without a shadow of a doubt, I don't think that's true. How they really work. That's another piece I want to talk about, right? So the business owner, there's 3 buckets of money in a typical captive, right? Number 1 bucket is the premium that the owner's putting in. Just as they write the check to some large national company today, they're going to put that into the captive. Then the second bucket is the aggregation of all those members together. That's the captive itself. And then the third bucket is the fronting carrier. So every captive has a retention. Think about like well, it's an SIR, so to speak, or a deductible. Anything above that, the fronting carrier is going to pay up to the limit. Anything below that, each and every loss, the captive is going to absorb that. So if you're a member in the captive and you have a bad year and all your loss funds get wiped out and you have additional losses, well, that's where risk sharing comes. The other members pick up a portion of that and they share in that cost. And that's what insurance, that actually happens every day in every insurance company in the world, right? The problem is that when you're in the traditional world, you don't get to see how it works. You don't get to pick who's going to be you're sharing risk with. There's just this huge, massive law of large numbers going on in the background. And whatever comes out of it is whether your client's getting a renewal increase. I mean, rarely do we see decreases, but you know, that's how that works. In the captive, you just get transparency and the whole process works. You get to see.
Well, and the client doesn't understand that. And again, it's because agents don't explain it to them, or agents are so worried about somebody getting pissed off because you actually pushed back a little bit that they're going to leave you because you pushed back. But I hate to rain on your parade, people. We have a responsibility to educate the people we represent. And sometimes that means you have to push back a little bit and have a conversation that may seem like it's uncomfortable at the beginning. But I mean, even on social, I see this all the time where people are griping about their homeowner's renewal. And I get it. Like, I don't get an employee discount for buying insurance. I pay insurance just the same as everybody else does. My homeowners in Florida goes up just like everybody else's does. But the difference is I understand how risk sharing works. The standard complaint is, I've been with this company for 5 or 6 years now. I've never had a claim, and they just raised my rates by X number of dollars. How is that fair to me that I've never filed a claim and they're charging me more? And my response to that is, that same company, if you would have bound a policy because you're buying a new home and you hadn't even made your payment to them yet, but the policy's bound and you have a total loss due to a fire or something else, and that carrier comes in and pays the whole thing, you're not going to complain about that, are you? Like, that's the swap, right? Is they're there to ensure insurance is not a savings account, people. It's not a savings account to go buy a new roof. People think, oh, I paid in premium for 20 years. It's time for me to have somebody, shady roofing company out do an inspection so I can get my roof for free because I've earned it. I've paid premium in. No, it's not designed that way. And when you go in and try and redeem your investment in insurance as a sinking fund to buy a new roof, you're going to shoot yourself in the foot, and quite a few other people, they're going to have to help absorb that loss.
Which is why all your homeowners renewals are going up in Florida since they hopefully they fix the law. But anyway, industries to look for, right? So I call it businesses with stuff. So businesses that have like, plants like manufacturers, distributors, construction, large retail operations. So when they're spending north of, for us, 250 grand, work comp, GL and auto. But here's really the three things that I look for in a prospect. And so for everybody listening, right? Number one, you got to have enough premium, which we just talked about. But two, how many businesses, I can't be, I know I'm not the only guy who's ever heard a business owner complain about their premiums going up, right? But when you have a business owner who's got premiums going up and they have low losses, and they're like, there's got to be a better way, right? There's got to be a better way. So they're willing to take a little risk on themselves. Like I'd be willing to self-insure. I've heard a lot of agents tell me that my clients just want to self-insure. Well, that's a different story, but that's the thing. They're willing to take a little bet on themselves.
Well, and let's be very, very clear.
Yeah,
when they say self-insure, they just mean they don't want to buy insurance.
They don't want to buy insurance.
Yeah,
exactly.
They just want to pay anything that happens out of pocket.
Yeah. Well, and then they realize that when we actually explain how self-insurance works, that it's not really insurance and you don't get the benefit of all the other things, and you're on the hook for everything if it completely blows up, which is,
that's why we tell people, if you want to take risk, make that quantifiable.
Yeah.
Buy a larger deductible, buy a larger self-insured retention. Don't go in and undervalue your property thinking you're saving a ton of money because your agent doesn't explain how co-insurance works or any of the other stuff. And we just see this all the time. Well, I only want to insure my building for $1 million, but your building's $10 million replacement cost. Like that's not how this works.
Yeah.
Well, if you're
most carriers won't even let you do that.
Right. But the thing is, like, they're thinking in their mind, anything that happens is going to be under $1 million, and anything over $1 million, we're probably going to be out of business anyhow. So who cares? Like that's honestly what they think, when the reality is, why are you taking a $2,500 deductible on a $10 million building? Like, if you really want to dance, let's take a $250,000 deductible, see what that does to your premium, but insure the building to value. So at least you can quantify that what you're on the hook for is not going to be more than that $250,000. And it really drives me nuts on the third party stuff where, they don't want to buy a specific cover, like cyber, for example. You want to self-insure for cyber? Like, I can't even accurately project what a claim is going to be, and you're willing to take a risk along those lines? Get out of here, man.
It's funny. So I'll have businesses, group comes into a captive, and now they want to put everything in the captive. Like, they get to see how it works. It's amazing. And I'm like, well, how much do you spend on your cyber insurance? I don't know, like $5,000. I'm like, all right, so for $5,000, you're transferring all this risk to somebody that's going to pay millions of dollars for you. Let's leave that out of the captive.
Well,
we're not putting that anywhere near the captive.
That's a really good point, and it's something that I talk to agents about this all the time. I can go write cyber with my direct carriers all day long, get paid 15 points, and hope for the best. Or I could go to pro writers, who I use for a ton of my cyber, and get, depending on who the carrier is, 12.5 to 15 points to write the business with them. I'm going to write it with them 100% of the time. And the reason why is because I can't think of another line of coverage that is so inexpensive that has such a high top side. Why in the world would I be so worried about just the incremental profit sharing I might get for $5,000 in premium on a cyber policy that could have a $4 million claim and completely wipe out my contingency? It makes no sense.
Yeah. Well, and
it's the same reason you wouldn't want to put it in a captive.
You would never take that exposure into a captive. I mean, you need, and so let's go back to kind of the last part, right? We talked about premium, kind of the three things I look for from, we looked at industries, and then the business owner. That is so important. So they got to have enough spend. They have to be willing to take a risk on themselves, because like I tried to put nonprofits into captives, and their boards, like for at least the ones that I ran into, they didn't want to take any risk. So that's okay, right? That's not, this is not for everybody. That is 100% true. It's not a silver bullet. When it works, it really works. But, and I think you mentioned this in a previous episode or something we did together, or maybe I heard it separately. Captives will not fix your risk management problem. It'll put the biggest flashlight in the world right on top of it and show you everything that's wrong. And so that's the last part. That's the one I look for the most. So Dave, if you're not a member of Killing Commercial, you need to be, because that's Dave speaking the truth here. Is the business owner has to believe that risk management, training, and safety will affect the outcome of their business, right? They'll invest in risk management and training and safety to get a better outcome. There are plenty of business owners, and this may shock you guys, I don't know, plenty of business owners who don't think that training makes a difference. And so that isn't necessarily the right guy to come into the captive, because here's what happens. If you join a group captive and you start having frequency losses and you have to take assessments or whatever the structure is set up for, the business owner is going to start paying more. And the captive goes to that business owner and says, hey, we got to talk. Like you're causing risk sharing, you're doing all this stuff. And the business owner's like, nah, not interested, not gonna, it's not me, it's just a bad year, whatever. If you continue to have bad years like that and you're not willing to fix that, you're gonna get kicked out. Simple as that. You're gonna get non-renewed. You've had all this money invested in the captive with collateral and all that stuff. That money is going to sit there. So you get kicked out of a captive as a business owner. Well, guess what? The captive is going to sit on that collateral for 7 years until they close out all the policy years that you were part of. So if you want to talk about, you can cancel the you can get out of the insurance, captive insurance tomorrow. Here's your accord form, cancel. You go buy insurance in the traditional market, be my guest. But every captive manager I've ever known, and certainly anything we would do, we're going to hold on to that collateral.
You have to.
And so we have to. That's exactly right. It protects the fronting carrier. It protects the other members from having to pay claims for somebody who's left, right? That collateral is super. It's like your big security deposit. So that's why it's so important for the business owner to have the right mindset of the management team, that they believe risk management, safety, and training are directly tied to their outcomes. And the more they can do it, the better they're going to be. I think that's all I got for this one.
Yeah, and I would say if you don't understand why they need to hold out for 7 years, like go look up what loss development factor means. I mean, you can start there, But
look, yeah. I've got a good graph on
the education piece for us as agents. We need to know these things. I went through, got my CIC, got my CRM, so I understand this at the level that they're able to teach there. But even that stuff's just a foundation. If you really want to go deep, and those are the resources you provide as part of Captive Coalition, right?
That's exactly right. I've got a great visual that you can give to your clients. Like everything we do is designed so that an agent can give it to their client. They can put their logo on it. We white label so much stuff because look, it doesn't benefit you if you can't use it in your business, right? As an agent, if you can't take a tool that we have and do something with it on the outside, I'm not here to get the accolade. I don't need my name all over the world. What I want is for you to get educated and then help protect that book of business you've worked so hard to build.
Yep. 100%. All right, everybody, we're going to wrap this one up. We're going to come back to you next week with the capstone, episode 4. We'll catch you then. See ya.